3 assets. That's the whole video. But what the title didn't tell you is that the order in which you build these 3 assets matters as much as which ones you pick. Get the sequence wrong, and they actively work against each other. Taxable events colliding with dividend income at the worst time. Real estate leverage eating through your liquidity when you need it most. I've watched that happen to people with 7-figure portfolios. By the end of this, you'll know not just what each asset is, but exactly how much capital you need to make each one replace real income, the specific sequence to build them in, and a tax mechanism inside the third asset that can reduce your effective retirement income requirement by 15 to 20%. Nobody explains that last part with actual numbers. I'm going to do that today. Let's start with the brutal reality. Fidelity's 2024 retirement data shows the median American between 55 and 64 has approximately $28,000 saved. Not $28,000 per year in income, $28,000 total. That same person, if they've been working since 22, has earned somewhere between $1.5 and $2.5 million over their career. $28,000 kept from $2 million generated. That's roughly 10 cents on the dollar. The conventional response to that statistic is you should have saved more. But that answer misses the actual problem. The problem isn't the savings rate. The problem is the mental model. 30 years of being told to fill a bucket, save more, invested, grow the number, die with money in the bucket, when what you actually need is a pipe. That's the frame for this entire video. A bucket is a finite pool you draw from and hope runs out after you do. A pipe is an income stream that flows whether you're working or not. Not a shrinking number, a flow. Every month, income arrives just like it did when you were employed. The bucket doesn't change. If you build the pipes right, the bucket keeps growing even while you're spending from it. That is financial independence, and it's a completely different experience than watching a balance sheet shrink. Pipes, not buckets. That phrase is going to come back. Now, before I get into the first asset, I want to set up something that's landing in about 8 minutes because it changes the entire retirement math calculation for almost everyone watching. It involves a specific tax bracket that the majority of people building toward retirement have never calculated for their own situation. I'm going to show you the exact income thresholds and what they mean in real dollars. Stay with me. But first, here's how broken the standard playbook actually is. The 4% rule, developed in 1994 by financial planner William Benn, who ran portfolio simulations against historical market data and concluded that a retiree could withdraw 4% of their portfolio in year 1, adjust for inflation annually, and have a high probability of not running out of money over a 30-year retirement. That became the bedrock of American retirement planning for 3 decades. Here's the problem. Morningstar published updated research in 2024. For a 40-year retirement, which is what you're looking at if you retire at 55 or 58, the updated safe withdrawal rate is 3.3%. Under current valuations and bond yield assumptions, some scenarios go as low as 3. That doesn't sound like a big difference, but the math is unforgiving. At 4% withdrawal, you need 25 times your annual spending. At 3.3, you need 30 times. On a $45,000 annual spending budget, that gap is the difference between needing $1,125,000 and needing $1,363,000, a $238,000 difference from a single decimal point change. That's not a rounding error, that's a house. You think the problem is that you haven't saved enough, but actually the problem is that you're planning around a bucket that requires 30 times your annual spending to be safe, when what you need is a pipe that replaces your annual spending indefinitely. Different goal, different assets, completely different math. Pipes, not buckets. Let's build the first one. There's a real estate attorney whose firm has 2 practice areas. One is real estate transactions, the other is bankruptcy. His observation, published in a financial planning forum I came across a few years back, was that the same clients sometimes appeared in both 10 years apart. Not because real estate is inherently dangerous, because the specific way most people approach it is. Let me tell you about Tom. Tom was a facilities manager in Columbus, Ohio. $62,000 salary, not wealthy, not struggling. In 2012, Tom bought his first duplex for $142,000. He put $35,000 down, money he had deliberately saved over 4 years without touching. After mortgage, insurance, property taxes, and a maintenance reserve of about 1% of property value annually, Tom cleared approximately $580 per month in net cash flow. His friends thought he was crazy. The math was unimpressive. $580 a month from a $142,000 investment. Tom kept doing it anyway. Second property in 2015. Third in 2017. Fourth in 2019. Each time, conservative financing, never above 70% loan to value, properties in a market he understood, managed by a professional taking 9% of gross rent, boring, methodical, relentlessly consistent. By 2022, Tom's 4 properties generated $4,100 per month in net cash flow, $49,200 per year. That is 79% of his $62,000 salary from 4 houses. Tom retired at 59. Not because he hit some magic net worth number, because he had a pipe. Here's what Tom did right that most people don't. He never bought for appreciation. He never stretched financing to make numbers work on a spreadsheet. He never moved into a market he didn't know because someone told him it was hot. Every property cash flowed on day one at actual real-world expenses, not optimistic projections. And he kept enough liquid reserves that when a water heater died, when a tenant left a unit in rough shape, when a furnace failed in November, none of it became a crisis. That's the engineering behind a durable real estate income pipe, and it's precisely why most people who try this fail. They buy with maximum leverage, they underestimate expenses, they count on appreciation to bail them out. The people who build great rental portfolios and the people who filed bankruptcy over real estate often look identical in year 2. The difference shows up in year 7 when something breaks and one person has reserves and one person doesn't. What does this pipe actually cost to build? If you need $50,000 a year in net rental income and your average cash-on-cash return across properties is 8 to 10% after all real expenses, you need $500,000 to $625,000 in equity deployed, not total property value, equity. 2 or 3 well-selected properties with 25 to 30% down, held conservatively in markets where housing demand is genuine and durable. That's the target. One landlord follow online describes his underwriting model as this: every tenant is one job loss from a payment problem. Every roof is 10 years from a replacement. I price both in before I make an offer. That unglamorous math is what separates durable rental income from a case study in financial pain. So, the real secret to real estate investing is just not being reckless with real estate. Yeah, basically the bar is that low. You'd be surprised how many people trip over it. Pipe 1 is real estate. More hands-on than the other 2. Potentially the highest cash yield. Requires conservative financing, genuine knowledge of your local market, and real reserves to survive the inevitable rough patches. It is not passive. It can be extremely profitable. Those 2 facts coexist comfortably. Now, here's what I want to tease before we get into the second pipe, because this is where the psychology of retirement income starts to matter as much as the math. In a few minutes, I'm going to introduce you to someone who did everything right, saved everything they were supposed to save, invested consistently for 35 years, and is still financially anxious every single day in retirement because she built a magnificent bucket and her brain knows it. The second pipe is what would have solved her problem. Stay with me. Dividend stocks pipe number 2. There's a concept called sequence of returns risk. Your financial advisor has probably mentioned it once. You nodded. You moved on. It is actually one of the most consequential ideas in all of retirement planning, and I want to explain it in a way that lands 2 retirees, same age, same starting portfolio, same average annual investment return, same withdrawal rate. Over 20 years, one runs out of money at 81. The other dies at 93 with money left. The only difference is the order in which the good and bad years arrived. The retiree who faced a 40% market drop in year 2 while simultaneously withdrawing principal to cover living expenses permanently crippled their portfolio in a way that even a full recovery couldn't fix. They sold shares at the bottom to eat. Those shares were never put in the portfolio for the recovery. The math broke irreversibly in year 2. The retiree who got the same crash in year 14 had 12 years of compounding as a buffer. The crash barely mattered. That sequence of returns risk. And it's why invest in index funds and withdraw 4% is an incomplete plan without knowing what happens when the crash arrives in year 3 of your retirement. Dividend stocks largely sidestep this problem. Here's why. When a high-quality dividend-paying company drops 30% in a market crash, they don't automatically cut the dividend. The S&P 500 dividend aristocrats, Companies with at least 25 consecutive years of dividend increases as a group maintained or raised their dividends through 2008. The financials cut theirs. Some energy names cut theirs, but the aristocrats held. The stocks dropped. The income didn't. Read that again slowly. The stocks dropped. The income didn't. If your retirement income comes from dividends, a market crash is an event you observe, not an event you survive. Your net worth on paper declines. Your income check is unchanged. You see the market down 30% on the news, and your actual life is completely unaffected because you are not selling shares. You are collecting distributions from businesses that are still operating, still profitable, still paying you. That is a categorically different experience than watching a balance sheet shrink while wondering if it will outlast you. Pipes, not buckets. By the way, hit subscribe if you like this content because YouTube's algorithm may genuinely never show you my videos again if you don't. I know that sounds like an overstatement. It isn't. The honest math on this pipe. Quality dividend payers, not the 8 and 12% yielders that look spectacular until the company cuts the dividend and the stock drops 50%, typically yield between 2.5% and 4%. The dividend aristocrats have historically landed in that range. Let's use 3.5% as a working number because it's realistic for a portfolio of well-selected, durable dividend payers. To generate $40,000 a year in dividend income at 3.5%, you need $1,143,000. To generate $60,000 per year, $1,714,000. Those are large numbers. Two things make them more achievable than they initially sound. First, the compounding timeline. If you're 50 years old today and you invest $5,000 per month in a dividend growth portfolio earning 7% total return, which is conservative by historical S&P standards, you cross $1 million in approximately 9.5 years. You're 59-12, which is perfectly timed for penalty-free IRA withdrawal. If you started at 45 with the same contribution rate, you'd be at $1 million at roughly 54 years old. Second, the dividend aristocrats have historically raised their payouts at 5 to 8% per year. Inflation has averaged about 3% over the past decade. That means your income pipe grows faster than inflation without you doing anything. Your $40,000 income in year 1 becomes roughly $43,000 in year 2, $46,000 in year 3. Automatically, the system will automatically adjust to the new settings. The pipe expands on its own while you're living your life. That's the compounding story dividend investors correctly won't stop talking about. It's not the stock price, it's the income stream growing every year. Now, the part most videos gloss over because I want to be honest with you. Picking individual dividend stocks that will sustain and grow their payout for 15 to 20 years is genuinely difficult. It requires reading balance sheets, understanding competitive modes, assessing management quality, monitoring debt levels. It's as much credit analysis as equity analysis. This is not a casual weekend research project with a stock screener. I run meaningful capital through a dividend strategy. I've spent more than 10 years running my own business while surrounded by accountants and fiscal attorneys who taught me how money actually moves at the level where it matters. I have real skin in this game, not theory, and I still use a specialist for individual stock selection. I want someone doing this 50 hours a week who's been doing it for 15 years with a documented track record, not someone beating the S&P. That's not the goal. The goal is durable income that survives crashes and keeps growing. That's a different objective, and it requires different expertise than chasing total return. If you don't have access to that kind of advisor, dividend ETFs do this job at very low cost. Vanguard Dividend Appreciation, Schwab U.S. Dividend Equity, iShares Select Dividend, diversified, cheap to own, and they pay you on a regular schedule. Your yield will be around 2 to 2.5%, which means you need a somewhat larger portfolio, but the durability is real and the management cost is essentially zero. What about those stocks yielding 10 or 12%? Those stocks exist. They're real and roughly half of them cut their dividend within 3 years. The high yield is often the market communicating that it doesn't believe the payment is sustainable. You want to learn that before you buy, not after your income drops 40% and the share price follows it down. Now, I want to introduce you to Sandra. I promised her earlier. Sandra is 63 years old. She has $900,000 in a 401k and a paid-off house. She did everything she was told, saved diligently for 35 years, invested consistently, deferred lifestyle upgrades, did everything right, and now she is retired. and she is quietly anxious every single day. Every month, Sandra withdraws $3,500 from her account to cover living expenses. Every month, she watches the balance go down. On months when the market is also down, the balance falls faster than she withdrew. Her financial advisor has shown her the Monte Carlo projections, 92% probability of not running out of money. Sandra does not feel like 92%. Sandra feels like she is holding a shrinking ice cube. Sandra has a bucket and her brain won't let her forget it. The financial services industry has actually known about this psychological phenomenon for decades. It's precisely why they love selling variable annuities, a product with a mortality and expense fee, a sub-ac account fee, a rider fee, and an administrative charge that together costs somewhere around 3.5% annually. But you get a monthly income deposit, and that deposit feels like a paycheck, and the brain relaxes. So what's my total annual cost on this product? Approximately 3.4%, which means I need a 6% return before I've made a single dollar of real gain. Long pause. Slow nod. Would you like to see the illustration? They are selling a psychological fix to a brain problem you can solve for free. With a dividend portfolio, you build yourself a pension without the insurance company's markup, without surrender charges that lock your money up for a decade. I'm going to come back to Sandra in a few minutes because the third pipe is the complete solution to what she's actually experiencing. But first, I want to set up something specific. In the case study I'm about to walk through, you're going to see how a 42-year-old making $95,000 a year builds all three of these pipes and reaches a retirement income of $68,000 at 58. With actual numbers, I find that most people have never seen this modeled concretely enough to believe it's real. So, let's make it real. Pipe number 3, the diversified portfolio with systematic tax-optimized withdrawals. This sounds like what everyone already does. Max your 401k, invest in index funds, withdraw in retirement. But there's a layer underneath that changes the math significantly, and it is almost never discussed with actual numbers in plain language. Most people who run traditional retirement accounts withdraw money in the worst possible tax sequence without knowing it. They pull from their taxable brokerage first, then their tax-deferred 401k, and ignore the Roth until required minimum distributions force the issue. Vanguard Research published a paper demonstrating that a tax-optimized withdrawal sequence, knowing which account type to pull from in which year, would extend portfolio longevity by 15 to 30% compared to an unplanned approach. Same portfolio, same spending, same investments, different withdrawal order. The difference between a portfolio lasting until age 83 and one lasting to 94 or not running out at all. Now, here's the specific mechanism I promised. Long-term capital gains, meaning gains on investments held more than 1 year, are taxed at 0% for single filers with taxable income below $47,025 in 2026. Married filing jointly, the threshold is $94,050. Zero federal tax rate on capital gains. If you structure your retirement income so that you're taking tax-free Roth distributions alongside long-term capital gains from a taxable brokerage account, and you time your Social Security start date to manage your income level, you can generate $50,000, $60,000, even $70,000 per year and pay close to zero in federal income tax. That is not a loophole. It is not an offshore structure. It is the standard United States tax code, and it is available to anyone. American who knows it exists and plans around it. What does this mean in practice? If you originally calculated that you needed $75,000 gross per year to cover $60,000 in actual expenses, assuming a 20% effective tax rate, and you now realize you can structure the income so that tax is nearly zero, you only need $60,000, which means your required portfolio size is about 20% smaller at 3.3% withdrawal. That gap is approximately $455,000 in required capital. Not from earning more, not from a lucky market, from knowing one specific mechanism inside the standard tax code. Here's the uncomfortable question. Who benefits from you not knowing this? Financial advisors whose fees are calculated as a percentage of your assets under management. The more assets you think you need, the longer you stay invested, and the higher their annual fee. I am not calling anyone a villain. The incentive structure just doesn't produce a burning motivation to walk you through the capital gain zero bracket. Proactively. Amuse disappointment, not rage. That's the right register for this. Now, let me build the complete picture. David is 42 years old. He earns $95,000 a year. He wants to retire at 58. That's 16 years. He's mapped his retirement expenses carefully. $60,000 per year after removing work-related costs, plus $8,000 for healthcare before Medicare eligibility. Target income $68,000 per year. David builds Pipe 3 first, the diversified portfolio. Because it's liquid, it compounds immediately and it provides the financial cushion that makes everything else safe to build on top of. He maxes his 401k at $23,000 per year. Employer match adds $4,000. He contributes $7,000 to a Roth the First IRA annually. He puts another $5,000 into a taxable brokerage account. Total $39,000 per year invested. At 7% average annual return over 16 years, David's combined portfolio at age 58 is approximately $1.18 million. At age 47, with a meaningful liquidity cushion established and his portfolio generating a sense of security, David buys his first rental property, $215,000, a single-family home in a stable mid-tier market with persistent housing demand. He puts $53,750 down, 25%. After all expenses and a property manager at 9% of gross rent, he nets approximately $580 per month. At 52, he buys a second property under similar terms. At 58, the two rental properties together generate $15,200 per year in net cash flow. His portfolio needs to cover $52,800 per year. At 3.3% withdrawal from $1.18 million, he can draw $38,940. He's short $13,860. He has $172,000 in his Roth account, completely tax-free. He takes $12,000 per year from the Roth. Gap narrows to $1,860. He fills this with a small draw from his taxable brokerage structured as long-term capital gains, keeping his total income under the capital gains zero bracket threshold. His total federal income tax bill approximately $2,000 on $68,000 of income. His net $66,000. Goal $68,000. Close enough that a single year of moderate portfolio growth eliminates the gap permanently. David didn't earn an extraordinary income. He didn't time the market. He didn't find some secret investment. He built 3 pipes over 16 years in the right order and managed the tax structure. He is 58 years old and he does not need a job. The order one more time, because this is the part that almost nobody explains. Portfolio first, real estate second, dividend stocks third. The portfolio is liquid. It's your structural foundation and your reserve. It means that when you buy real estate, you're not leveraged to the edge. You have cash for vacancies, repairs, bad months. Real estate without liquidity is a ticking clock, and dividend stocks to deliver their full power need as long a compounding runway as possible. Reinvesting dividends for a decade before you need the income is how you build an income stream that keeps growing on its own. Try to build real estate first without a liquid base, and you're one bad tenant away from a forced sale at the wrong time. Try to build dividends first and tap them early, and you interrupt the compounding cycle that makes them powerful. The sequence matters. Almost nobody tells you the sequence. Now, let me close the loop on Sandra because her story resolves here. Sandra's $900,000 is a bucket. Her anxiety is real, and it is not going to be resolved by a better projection model or a more confident financial advisor. What Sandra needs is to restructure her withdrawals so her brain experiences income rather than depletion. A portion of her $900,000, say $250,000, moved into a dividend ETF structure, generating 2.5%, creating approximately $521 per month in income deposits. A short bond ladder covering 2 years of expenses, maturing in predictable intervals, functioning as a self-made paycheck schedule. A Roth conversion strategy in her early retirement years that reduces future required minimum distributions and builds a tax-free reserve she can draw on without triggering taxable income. Her portfolio doesn't grow faster. Her math doesn't change dramatically. But now, there are deposits arriving instead of withdrawals leaving. The balance still fluctuates, but Sandra's brain registers income instead of loss. The anxiety doesn't disappear. It becomes manageable. The math was always fine. Now the psychology catches up. Pipes, not buckets. For Sandra, for David, for anyone building toward this, the difference between retiring at 58 and working until 66 is rarely the portfolio size. It's almost always the model. Whether you're building toward a bucket or building toward a flow, 3 things to take away. Specific, non-generic. 1. Define your target as an income number, not a net worth number. Map your actual retirement spending, not a percentage of salary, not a round number, not what a calculator spits out. Real line items. Subtract what disappears in retirement. Commute, professional clothing, work lunches, possibly 1 car. Add what appears, healthcare before 65, any lifestyle. Costs that increase with free time. That number multiplied by 30 is your portfolio target. Divided by 3.5%, it's your dividend pipe target. Accumulation is the means. Income is the end. 2. If you're starting a dividend pipe today and you don't have access to a specialist advisor with a documented 15-year dividend track record, begin with ETFs, Vanguard Dividend Appreciation, Schwab U.S. Dividend Equity. Set automatic dividend reinvestment until you're 3 to 5 years from your target retirement date. Then switch to income mode and let the distributions land as cash. You're not trying to beat the market. You're building a pipe that pays you. Different goal. 3. This week, not someday. This week, look up the long-term capital gains 0% income threshold for your filing status in 2026. Open a spreadsheet and map what your retirement income would look like, drawing from a 401k versus a Roth versus taxable capital gains in different proportions. If you can shift your effective federal tax rate from 20% to near zero on $65,000 in annual retirement income, that is $13,000 per year, you keep. Over a 25-year retirement, that's $325,000. From knowing one number in the tax code that has been sitting there the whole time. Every morning you go to work as the only pipe in your own financial system, you are running a single point of failure operation on your entire financial life. One layoff conversation, one health event, one reorganization, and the water stops. These 3 pipes are not built overnight, but every year you spend building them is a year you are not waiting for permission to stop. Lazy investing built more fortune than crypto memes. And if you're the person who's been meaning to start this seriously for 2 years and hasn't, the best time was 2 years ago. The second best time is not when you feel more.